focus should be on is income sufficiency rather than just the total balance. So if you think about it in a traditional sense, you'd go, okay, I'd need X amount of dollars and I'm going to draw an income stream from the day I retire until the day I pass away, and it's going to be linear. It's going to be the same, right? Whereas
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are talking all about your retirement in the next couple of years.
Andrew, I'm 39. I keep telling you that. I am so far away from that age. That's not funny. It's not funny. So yes, we are talking to everybody about retirement planning today, and we're talking to everybody about 60 being the new 50.
Yeah. Nice. That's a nice little ring to it. 60 being the new 50. Orange is the new black.
It's kind of like a throwback to,
right.
all of these things as you, I don't know, whatever. So botch that one up. But, 40s is the new 30s and so on and so forth. But look, I think ultimately what it leads to and comes back to the retirement question is that the shape of somebody's life has definitely changed. And the traditional, I guess, thinking around retirement has shifted. And we need to think about, where we're going, how long we're going to live, what's that going to look like? Is it not in the traditional sense, but the traditional sense was finish work at a particular age. Traditionally, it was 65. Get access to super, get access to the age pension, live 5-10 years, and then cark it, right? That's completely changed. Andrew, what are some of the things that we should be thinking about? Where do we start?
Yeah, I think what we're ultimately getting at here is that people's retirements are not quite as linear as what it has been in the past. And in addition to that, as people's lifespan increases, you've also got a longer retirement. And it's not just that, okay, one aspect of it is that people are living, say 5 to 10 years longer than what they were doing in previous generations. So it means that retirement is now, 25 to 30 years as opposed to, 15 to 20 years. So there's that question around how do you fund that additional, time frame in retirement. But as your lifespan increases as well, what also happens is the end years are progressively longer. So we're keeping people alive longer that are in ill health. And so what that means is that, things like a necessity for aged care, a necessity for a more intensive care at the later stages of life is also there. So really what we look at when we start to talk about this is, when can I retire? How long can my money last? And what are some of the considerations that you now need to start throwing into the mix when previously, retirement was, as you said, turn 65 years old, you claim age pension, you've maybe got a little bit of money in the bank, but more or less you're living off your age pension income and that's it.
Mm-hmm. If we're living longer, so yes, we're living longer, tick. Medical advancement is keeping us longer, keeping us alive for longer. I also think that we're getting smarter around nutrition and exercise and all of the stuff associated with that. So what it does mean, I think, is when you enter your retirement years, it's not like, I don't necessarily think it's, hey, we're retired, put our feet up, stay at home, watch the idiot box, and that's it. It's, we want to travel, we want to see the things and sights, and that stuff costs money. So the whole thing about, okay, not only am I living longer, it's what am I doing in that time frame, which really then pivots into that second part of that statement that you said is not how much money do I need, how long or when can I retire, is how long can my money last? Yeah. And we'll talk about that in a little bit of detail and stuff like that. But what it means, in my mind and the experiences that we've have with people is retirement really means stopping work completely. So a lot of people tend to transition, and not necessarily from a monetary perspective. I mean, it could be that, but a lot of it is the fact that people are still getting enjoyment out of working. It gives them a purpose. There's some social connection with it, and they're obviously contributing to society with the skill set that they've got. So we're seeing more and more of a phased retirement starting to happen and occur, as opposed to, hey, I've been in this job or this career that I've hated for 40 years. I can't wait to get out of there. It's not necessarily that anymore.
Yeah, you pick up your gold watch and you move on to age pension. Yeah. I mean, look, I think that the flexibility that people choose, and I think everything contributes to it. So it's not one thing, it's definitely multifaceted. But number one, when you live in a world that all of a sudden you can work from home, you can not necessarily need to be in the office 24/7. A workplace is far more flexible with its staff in that, they're supportive of retaining some talent. And, when the talent pool starts to diminish, you really need to retain workers that have been there for a long period of time. And so all of a sudden, people aren't just finishing at 65. All of a sudden, people are, maybe going part-time at, in their late 50s or maybe in their 60s. And they're having that flexibility of being able to phase out retirement. I mean, I know a number of people and clients that they retired and all of a sudden, a couple of years later, they're back at work and they're maybe not necessarily doing the job that they were doing previously, but are doing a, more menial and, easier job, because they got bored and they're like, hey, I'm not, getting enough fulfillment out of just staying at home. I still feel like I'm young. I don't feel like I'm, in part of that pool of people that can just retire. And so I just needed to do something and go back to work. Whereas, and that was something that was maybe happening 5-10 years ago. Yeah. Whereas nowadays people are saying, you know what, I'll do it part-time and I'll get the best of both worlds.
Yeah. Yep. No, completely agree. Thinking through, I guess, the traditional thinking around how much, and we'll throw some numbers around with this as well too, but how much is enough versus the income sufficiency. So if we have a look at some of the literature that's out there, so the Association of Super Funds of Australia, they've got a benchmark. I think it's actually $690,000 now for a couple to have a comfortable retirement.
I think that's, I mean, I don't want to swear on the podcast, but
yeah, no, it's BS.
Yeah,
it is. But you need to look through that. So what that means, or the way that they've come up with that figure, they've defined what a comfortable lifestyle gets you. So if you go to their website, you'll actually see what that means. Plus, there's an expectation that at some point in time, your assets are going to get to a certain stage where you'll be eligible for the age pension, with the assumption that the family home is paid off. Yeah. All right. So your dwelling, you own it. Right. I tend to agree 690, where the number is now, is definitely not enough. If you had to pick a number, and I hate doing this because I don't like to think about it in a capital value, but you're probably closer to $1 million. Yeah, that's where it's at. But what I think the focus should be on is income sufficiency rather than just the total balance. So if you think about it in a traditional sense, you'd go, okay, I'd need X amount of dollars and I'm going to draw an income stream from the day I retire until the day I pass away. And it's going to be linear. It's going to be the same, right? Whereas everything that we were talking about, you tend to find that at the start of your retirement, if you've got that vitality that we were talking about, your income needs are going to be higher in your 60s than when they are in your 70s or your 80s. Yeah. Until that cost of care, medical expenses increases and stuff. So you start to think about the shape of your retirement and when you need it to maximize the lifestyle that you want to lead at that particular point in time, as opposed to, I've got a lump sum amount of money and it just needs to work for me, and all I need to do is die before my money runs out. I think that's a really poor way of thinking about it.
And you need to also assess and look at, where is the money sitting? How's it structured? Is it right for me? I mean, $1 million in superannuation is very different to $1 million in a property, because $1 million in a property means that you're surviving off rental income. Rental income is fixed. You cannot draw any more. And so when you're talking about that, maybe earlier years where you want to travel and do things, you can't shape your retirement, draw more out in the early years and less, as time goes on. Your income level is very, very fixed. And so having an understanding of, okay, where am I drawing an income from? What are the tax implications? Is it going to be, taxable income or, superannuation, which shouldn't attract any tax associated with it? How am I trying to shape my retirement? And what do I want with the money at the end of the day as well? Because for some people, it's, I'm happy to, the day that I, touch wood, leave this world, I spend my last dollar and that's it. And maybe my beneficiaries will inherit the family home and that's sufficient. And maybe for other people, it's, no, I want my $1 million to still be $1 million when I pass away and I just want to live off the income. So putting a number behind it, I think is, it's dangerous because it barely paints, half the picture. I think that having an income goal, knowing where you're going to draw that income from and knowing how you want that to look is a far more accurate number to be able to shape up what you want your retirement to look like.
And I must say, look, it's different for everybody. Like you talk about that, and some people, just want to live whatever they want to do. They just want to be able to say, yep, I've got the money, I can go and do it. Within reason, obviously, without being reckless. And then you've got other people that turn around and say, you know what, I'd rather live a bit more of a subdued lifestyle, hang on to my money because I want to be able to make sure that my kids are looked after and so on and so forth. So there's no right, there's no wrong. I guess our job as advisors is to help people recognize that, show them what's possible, and then come up with a solution that best meets that need. Thinking about your investment, and I know that we spoke about superannuation versus non-superannuation. We'll double down on that again because there's a huge difference between that from a taxation perspective. Obviously different if you're talking taxable income versus no tax at all. But thinking about when you've got your money invested in your accumulation phase, so not from a superannuation sense, but when you're growing your assets, regardless of where it's held, you're probably predominantly thinking about the growth of the asset. So you're thinking of capital appreciation, whereas using retirement as an example, whatever that looks like for you, it moves more towards the income stream. So thinking through what you were describing before, if you've got $1 million in an investment, set of investments that are producing income, or you've got $1 million tied up in a property, that property, the income that you're only ever going to get is as high as what the rental income will give you. Whereas with the investment, that will change depending on the performance of the underlying assets. So thinking about down the track, when I am looking more towards income to sustain my lifestyle, moving from a growth phase in terms of your investment methodology and thinking towards income producing assets.
Yeah, absolutely. And there is a balancing act between it. I mean, you can, and I have seen many times before, shift the dial too far. So yes, as you start no longer contributing toward your assets and you're starting to draw down on your assets, you generally want to move toward the more defensive side of more defensive portfolio in order to be able to protect the balance, because a downturn in the initial stages can mean a significantly lower impact at the end stage. However, sometimes you're talking to people and their expectation is, great, now I'm retired, I'm going to move everything into a term deposit and take the risk out of absolutely anything, without recognizing and realizing that, okay, if you are now in an income drawdown phase at say 60, statistically you've still got a 25-year time horizon. Your investment time frame is still long-term. Even though you're drawing down on the asset, you've still got a long-term time horizon. And so you don't want to lose growth in its entirety, and you don't want to take, all the risk out of the portfolio, provided that you can obviously withstand, that volatility. But making sure that you're not swinging too far defensive is also something that's going to help support the longevity of those assets as you start to, draw down on them in retirement.
Yep. Circling back to superannuation, and probably more so the focus for me is the tax effectiveness of it. I mean, obviously we've spoken till the cows come home about the accessibility of superannuation. You can't access it at only certain points in your life, but I think the assumption that we're making with the conversations is that, you meet that. So really what I wanted to focus on is the difference between an income stream that is taxed or an asset that is taxed versus not taxed. And look, that's pretty straightforward. If you didn't have to pay income tax, just apply that thinking and that methodology to where you're at now, it'd be so much better in terms of the financial outcome for you and your family versus the alternative of paying tax, right? So we tend to lean a lot into superannuation when it comes to thinking around, retirement income per se, because it takes the tax equation off the table completely, and you don't have to talk gross, you don't have to talk net. Everything is just non-taxable. Obviously there's some thresholds around that and bits and pieces. We don't need to get into that level of detail. But for the vast majority of people, you're going to be drawing an income stream from retirement that's not going to be taxable at all.
Yeah, exactly right. And so if you can maximize, and as we start to get towards the later stages of preparing for retirement, generally superannuation forms a bigger part of it, because you're really trying to maximize as much money as you can put in. And if you don't plan for it enough, and you haven't, put money along the way, you can be capped, and it can be a position of, there's only a certain amount that we can put in, and the rest is going to be subject to income tax. So plan early is the big takeaway with it.
You know what they say, Andrew? If you fail to plan, you plan to fail.
Exactly right, Bills. You got the puns down pat.
Just in time for the Melbourne Cup,
Yeah, exactly right.
Because there's a few of those with the commentators that are on the mic. Andrew, what about, protecting retirement income from inflation and volatility? I mean, they're two things that we've probably seen a fair bit of, at least the inflation, genie sort of pop out of the bottle of late. But how do we think about that? I mean, you referred to term deposits before, and, using the example about someone wanting to take all the risk off the table. Well, you don't actually take all the risk off the table. You still assume some risk. But how do we think about, inflation and volatility when we are drawing retirement income, or when we are retired?
Look, they're the two things that are both working in opposite with each other, right? So you think about your biggest risk, which is inflation. Not maybe necessarily your biggest risk, but one risk, which is inflation, in that I don't want to take any risk. I'm going to just get a fixed level of income. That's great. Yeah. However, all of a sudden, if costs increase, and we have seen inflation rise over the last little bit, then the issue is that your fixed level of income that you're anticipating would deliver you X lifestyle is now more expensive, and you need to take on risk, which then creates volatility to deliver a high level of income. So one of the ways that we think about it is you almost look at a bucketing strategy around your investments. What's going to be your shorter term investments? They're going to be your risk-free assets. They're going to be your assets that you're going to draw down upon immediately if you need to, pay for those holidays, if you need to pay for your living expenses. You've got your, medium-term bucket that you're probably not going to touch for, 2 to 5 years. And that's going to be something that you maybe can take on a little bit more risk, but you don't want a huge amount of volatility, because you're still going to, draw down upon those assets at a future point in time that's not the too distant future. And then you want your assets that are in, longer term investments to have a little bit more growth expectations, which is going to increase the volatility and some of the risk against the portfolio. So that you're really being able to manage that process holistically. So you have a combination of absolutely everything. And same story with, your investments. You diversify as much as you can, so that if there's a decline in one area of the portfolio or one area of your assets, then it's not going to impact all of your assets. Because, the risk is that if you take on too much in growth assets and there's a decline at the early stages. So say you've got that $1 million that we're talking about invested, and say there is, something like a financial crisis that happens, it's a 20% decline. Now you've got $800,000 that you're drawing down upon. So even when the market then subsequently rises back up, you've drawn down upon some of those assets at the low point, and you're not going to recover that $200,000 that you had initially lost at the very beginning. Whereas if you can isolate, a large portion of it that's going to be long-term in a bucket, that's going to ride the wave. And even if there is a 20% decline, that's fine. That'll come back. But my shorter term assets and those things that I'm going to be drawing down upon immediately, you're taking on less risk, so that if there is a 20% decline, maybe you're only impacted, 2 or 5%, and that's fine. You can afford that in the shorter term bucket. So really trying to build a holistic strategy and essentially build your short, medium, and long-term buckets.
Yeah, I mean, that's talking about sequencing risk. One of the other ways to do it that people may have heard about, and it leads into a quote from a main man, but we'll talk about that in a sec. You draw down no more than 4% of your capital based on, you're adjusting your income stream for that year based on what the portfolio started with or how it performed, right? So the idea is adjusting it based on what's happened with the value of the portfolio on the markets and stuff, as opposed to saying rain, hail or shine, the market might have dropped 20% because of GFC-like event or what have you, but I'm still going to take out 100 grand or whatever it may be. Warren Buffett's famous for this. So depending on what the Coca-Cola share price does, that influences what he buys for lunch or breakfast or something from Macca's or whatever he does. He pivots depending on...
Pretty sure he could have afforded, irrespective. Maybe it's a habit from on...
Habit, I mean, would you call it a habit? Would you call it discipline? I mean, he definitely doesn't need to think about money in that respect, but I don't think it's about that.
No,
honestly, once you get to that level, right? It's his principle. It's the way that he thinks about it, and he's obviously disciplined enough to stick to it. But something that you need to be mindful of, which is the reason why it's important to get professional advice, especially when you're thinking about, retirement income, portfolio construction, volatility, inflation, sequencing risk. You can't recommend it enough because it could be the difference between running out of money soon or sooner versus having the level of money to give you that financial security to live the lifestyle that you want.
Yeah, I'm with you. Bill's really, I think that when you're talking about retirement, I think that it's defining what your goals and your freedom looks like as opposed to just your finances. So when we start, designing something like this for a client, I mean, it's about understanding what choices and lifestyle you actually want in retirement and how you build the income to be able to support that. It's not just about money. So what do you want retirement to look like? Is it, traveling? Is it volunteering? Is it, part-time work in the early stages? What does that goal look like? And then how do you make the strategy facilitate that goal? As opposed to just looking at it and saying, I need this level of income. That's what I've been earning previously. I need to match that in retirement. And that's it. It's a financial plan is a vehicle for the vision in what you want in retirement, and that will change because what you maybe think that you want in the early years may not be what you actually want, and so it's just a matter of realigning that plan and realigning that strategy to help meet the new goal. But start with a goal. The financial plan should be to help support that goal.
Redefining retirement. It could be the name of a book, Andrew.
There you go. We're writing a book now, are we?
Apparently so. But
that's all right. We've got Sam to.
That's it. She can write it, definitely. It's, look, hopefully everybody got a whole heap out of that today in relation to retirement and some of the things that we think about and thinking about your retirement and redefining what that looks like. Andrew, thank you.
Bills, thanks again for another great podcast. Thanks to our viewers and our listeners for tuning in. If you did get some value out of that, or you do want to discuss anything further with Billy or myself, details are in the show notes. But please like, subscribe, and we look forward to catching you on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.